Welcome to Sikich and our continuing online webinar series. Today we're going to be discussing the Secure 2.0 retirement legislation that recently passed in Congress. We're going to look at the tax implications for employers, employees, and advisors. Again, joining me today, we've got Karen Sanchez in our Naperville office, Marie Marks in our Indianapolis office, and myself, Jim Brandenburg, in our Milwaukee office. And again, we welcome you all for joining us for our session. First, a few housekeeping items just to address for you. Again, we encourage you as the attendees to submit questions in the chat feature on the control panel. Again, we'll try to address some of those questions as we go along. If not, we will follow up at the end of the session and afterwards and provide answers to those questions. We will launch polling questions throughout the webinar, so please complete those in order to receive your CPE credit for today's presentation. The presentation slides, the PDF of the slides can be downloaded from the handout section of the webinar. We also have included within there for your reference some other materials and resources. There is a, from the Senate Finance Committee, is their discussion on Secure 2.0 that was released in December, and there's also the Joint Committee on Taxation, their revenue estimate for the bill. So both those are in there along with the slides. At the conclusion of the webinar, a short survey will launch that will need to complete it for your CPE credit. The certificates will be sent out approximately 2 to 3 weeks afterwards. So what we're going to be sharing today is what we currently know about Secure 2.0. Please know that there are some questions we'll not be able to ask. Again, we're going to need some guidance from the IRS on a number of the issues in there. We'll comment on that on some of the various provisions that are out there. But again, we'll do our best to address some of the questions and some of the information that's available at this point. So that's some of the housekeeping with it. Again, we're glad that you can join us with it here as we look at this new legislation. Our agenda we're going to cover here is, again, just a little background and update on the legislation when this passed from Congress. We're going to look at the Secure 2.0 provisions. We're also going to look at some of the administrative provisions for some of you that work with some of the details of some of these changes, and then some other provisions to watch. Again, what we're going to cover is some selected items within it. There's quite a bit in the Secure 2.0. We're not necessarily going to cover everything within there, but just make sure that we're going to cover some of the highlights to make you aware of it. And again, we'll be all watching for some of that future IRS guidance. So first, we're going to just look at a little background about this legislation. Again, Secure 2.0, many favorable provisions within here. Again, I think for employees, for some of the participants, for some of the employers, retirees. This bill is referred to as Secure 2.0. Just a little background with it first. It passed, this bill passed in March this past year, 2022. And then a similar bill moved from the Senate Finance Committee in June of 2022. Had a different name though. Some of you may have been following this along. It was EARN, Enhancing American Retirement Now. Again, same concept, many similar provisions, just a different name with it. One thing that was unique with this Secure 2.0, it had some bipartisan support. Both Republicans and Democrats on board with it, and both the Senate and the House had their support for it, even though there's some slight differences with it. Again, as you might know, that again, if we have Secure 2.0, it's a follow-up to Secure, the first Secure, or some now referred to as Secure 1.0, that was enacted in 2019, and it built on some of the provisions that were in there. Again, that was setting every community up for retirement enhancement. It was, again, back in 2019. And what I'd like to just go through is just a couple of the items that were in that initial bill, just to kind of get a backdrop here before we get into 2.0. When you look back at what was in the this recap of the Secure that was passed in 2019, again, some selected items. One of the key ones within there was that payouts from IRAs for non-spouses were supposed to be paid out over a 10-year period. Initially, or before that, it was a longer time frame. That was a 10-year period that was in there. Some of the other changes, some modifications to retirement plans to allow small businesses to set up their plan with less administrative cost. And they could also include some part-time employees. Required minimum distributions, again, that's got some further changes here we'll talk about in a little bit. But that used to be at age 70 and a half. That was moved to 72 in the Secure initial bill. allowed 401ks to have annuities, allowed the use of 529 accounts for qualified student loan repayments up to $10,000, and also allowed some penalty-free withdrawals from 401k accounts up to $5,000 for the birth or adoption of a child. So those were some of the initial provisions within there. And one item to note with the Secure 1.0 is, next slide please, is this 10-year payout for the IRA payouts. When that passed with part of Secure, the first Secure 1.0, the initial interpretation was that you have that 10-year payout that they wouldn't need to take any distributions out until the 10th year following that. When the IRS had some proposed regulations just about a year ago, it said that you would need to take out the RMDs in years 1 through 9, and then the balance of that was taken out in year 10. So that was quite a change with it when they came out with those proposed regulations. One thing to watch out for the final regulations perhaps this year with it as to what the payout is supposed to be for those non-spouse inherited IRAs. Okay, next slide here. Moving on back to Secure 2.0. Again, while there was a strong bipartisan support in both the House and the Senate for this bill, there were some differences with it. Again, you need to have the same legislation in both the House and the Senate with it. Those differences were resolved in the Senate. They got the leaders in the tax writing committees together. And then the final passage of the Secure 2.0 occurred late in 2022. And what they did was they attached this to an omnibus spending bill, this Consolidated Appropriations Act 2023. That was the legislation that Secure was attached to it. They attached this bill, but there were some other business provisions that did make it in the mix with Congress, but they wanted to make sure that this Secure 2.0 was included with it. It was passed in Congress on December 23rd, just before they broke for the end of the year, and was signed into law on December 29th. One thing to note here is, we put at the bottom here, this date of enactment, again, was December 29th when it was signed into law. It's important to note these items because a number of these items, and both Karen and Marie are going to go through this as well, is the effective dates for a number of these provisions are all over the board. Some are effective right away, some are effective next year, or some are in 2033. So they're all over the board. So it's very important for any of the items that you have is to look at those effective dates for any provision that you have to see when it applies. Some of these were changed right at the end too. You may have followed it when it was in the House or in the Senate earlier. You may have seen a provision that you were following, and you saw the effective date. When they got to the final passage, some of those dates changed a little bit. So again, make sure when you're looking at it, you're looking at what was actually passed here in the final bill in December. Again, the primary goal with again, Secure 2.0 was to encourage retirement savings. Again, that's a major emphasis with Congress, and allowing access to funds for emergency purposes as well as simplifying administration. Again, those were some of the stated goals that they had with Secure 2.0. There are also some provisions in there to study the effectiveness of certain things and report back to Congress and how they're doing with that. Again, as I mentioned, there's a number of provisions. We're not going to cover them all. There's 90 provisions within there. And again, as I noted before, the effective dates range from immediately. In fact, there's even some that are retroactive to some that are out to 2033. Some may need some plan amendments, the record keeping. So, keep an eye on that. We'll try to highlight some of those that are either required changes or some that may be optional with it. And each of these ones, as we noted at the beginning, is going to need some IRS guidance with it so that they address some of these provisions. And I'm sure that the IRS now is looking at these, and some of the ones that are going to be effective right away, they're going to try to get those, some of the guides or regulations out on those right away. And then they're still at the same time issuing some guidance related to that Secure 1.0. So the IRS will be busy for some of these retirement provisions. So you're going to have to keep an eye on those over the probably next several years with that. And again, as I noted before, the last thing is just that, again, these are some of the selected items within here, these 90 provisions that we're going to cover today. So that's just an overview of what we've got in here. And at this point, we'll get our first polling question. Again, our first question, have you learned every provision of Secure 1.0 prior to Secure 2.0? Again, we just talked on that a little bit, that we are going to have this 2.0 we're going to cover today. Your choices are yes, I have studied this and can recite every provision. Maybe there's a few of you are with that. Yes, I have general understanding of provisions. No, my advisors inform me what information is needed. And no, are you kidding? I can barely get through my daily tasks. So anyway, select one of the 4 choices here and we'll see how results turn out. We'll give you a few moments with that. Okay, a couple more seconds here. We'll close that polling question off. Okay, let's close. Let's look at the results here with it for the first polling one. Again, only 1% has studied all this. Again, if they could be presenting this here. 33% have a general idea. That's good. Another about the same, about 30% have advised and informed them. And then the largest, are you kidding? We just have enough to go through here. So good. That's a good, backdrop here, so we know what we're going to have today here. And again, we're trying to get you some of the highlights with it, but also some of the information that you may need to follow up on. So good. Thank you very much for answering that. We've got some other polling questions later. We'd like to do now is turn to some of the provisions in Secure. We're going to go to Marie to address those. Marie, thank you.
Thank you, Jim. So Secure Act 2.0, and I bet everybody's super excited about this. Karen, Jim, and I have been watching this for quite a while, and we thought when it came out, it would give us clarification and would be very simple to implement. As Jim said, it isn't anything but simple. There are over 92 provisions in here, and we aren't going to cover them all, but a couple of things I want you to think about as you listen in today is the first, some of these are going to be required and some are optional. And there's actually a lot of optional features in this one, which we usually don't see, which is kind of exciting. It allows you to make determinations of what you might want to add or utilize inside a plan. So kind of keep that in mind as you see some of the things. Is it something that you want to talk to your plan administrator, your advisor, or your record keeper about? The other one that Jim mentioned is dates. The dates are all over the board. So you will hear some that are required now. Some are retroactive, and some of them go out to like 2026 or 2027. So as you hear something that we might touch on that is not coming out for several years, we will probably have more clarification before that happens or we get to that point. So you'll want to kind of earmark it if it's something you're interested in, but don't be panicked about that one right now. So we're going to start with the small employer pension startup credit. And why is this important? In the old rule, it was 50% of annual costs up to $5,000. Now it is 100%. That is good for the first 3 years of a new plan. It does have to be a plan started after this year. So anything starting this year, you're going to get the full tax credit. If you have a plan last year, you still get those tax credits. But keep in mind now that it is a much higher tax credit than we've ever seen in this kind of situation. And that's to be able to allow companies to start these small plans to be able to start. It is for companies under 50 employees. Typically a small plan is under 100 employees. So keep in mind to get the full 100% credit up to 5,000, it's 50 employees or less. It also provides an additional credit for 5 years for employer contributions of up to $1,000. That does phase out. It is, I believe, 100% of the 1,000 for the first 2 years. Then it's dropped by 25% over the next 3. So if you are looking to start a new plan, a lot of times we have companies that may not want to add an additional contribution. Keep that in mind that you do have this additional contribution or tax credit for that additional contribution in there. Karen, next slide. Expanding automatic enrollment. This gets a little tricky. This is one of those ones that you have to kind of look at and say, how do we want to handle this? So We now can have automatic enrollment. You will now be required for any new plan to have automatic enrollment. If you have a plan in place, you do not have to add automatic enrollment. If you do have a 403B, I think somebody had submitted that question prior to the webcast and asked if a 403B has to be included. Yes, it does. 401k and 403Bs are going to be in the automatic enrollment arrangement. You can start at 3% and go up to 10%. And then you do have to have auto escalation of 1% per year for a maximum of at least 10%. Anyone that is in the automatic enrollment does have a 90-day opt-out. So if they forget to opt out in day one, they can come back later. Typically, we see when there is automatic enrollment, people typically will stay in. The biggest problem people have is making a determination. So sometimes it's easier to do nothing than to do something. So in the past, if you didn't have automatic enrollment, people would look and say, I don't know how to do this. I don't know what to pick or what investment, and they'd sit on the sidelines. Well, this allows people to kind of get into the game. And instead of opting out, we find that up to about 10%, the percentage of people that stay in is much higher. So this is a really good feature to get people to start saving for themselves. There are two things that you do not have to be in or elect automatic enrollment if you have a new plan under 3 years, or if you have under 10 employees. So once you hit 11 employees, this is where it gets a little sticky or a little messy. Do we have to have that in place day one? When do we have to get that other person in place? So these are some of the questions we're looking at. So if you're a small plan, you're starting a new plan, you may want to go ahead and just start adding the automatic enrollment in there instead of waiting for 3 years if you're a new plan under 3 years. Next slide. Your RMDs. Many people have heard that the RMD has been changing. One of the reasons we're seeing this inside of here is because the retirement plans are geared to give retirement income. It is not an estate planning situation. And so a lot of people ask, why do we have to do an RMD? That's really why the RMD is developed, so that people are utilizing it and then pulling the money down at retirement, not trying to defer. And there are other vehicles you can use to be able to do that. So the current age is 72. It now goes to 73 as of January 1st, 2023. And then to age 75 starting in January 1st of 2033. I've heard people ask, and they're trying to figure out, how do I know really when I have to do, what age am I? So I've seen a chart that says if you were born between July 1st of 1949 through 12/31 of 1950, your RMD age is 72. If you were born between 1951 and 1959, your RMD age is 73. And if you're born after 1959, or actually 1960 and beyond, your RMD age is 75. Makes it a little easier to try to remember, where it might fit in. In addition, in the past, if you did not take your RMD, there was a 50% excise tax on that, but pretty high. And a lot of people forget to take that. You would think everybody would remember, but if you have things that are at other places, you didn't consolidate everything, you might miss that. So they have made a change. It is now decreased to 25%. And if you make the correction in a timely manner, it actually will be reduced to 10%. So that is a great benefit for those that have missed their RMDs in the past. And also, you do not have to do RMDs from designated Roth 401k accounts beginning in 12/31/2023. So at the end of this year for that one. Next slide. The catch-up limits is also another area that they really wanted to look and say, what can we do for participants or people that have had to step out of the workplace? And this really is where this special little catch up came, so that if you have a elderly parent, you may have had to take off time to take care of them, or you stepped out of the workplace for having children. It is adjusted, so currently it is $7,500 for 2023 for the catch up. It will be raised to $10,000 for participants ages 60, 61, 62, and 63 before the close of the taxable year, effective December 31st, 2024. We're not really sure why they picked just that range and why didn't they stop at 64, but this is the time frame they took. There is another little caveat to this, that it is actually 10,000 or 150% of the base wage, or the base limit. And in 2025, the base limit is 8,000, so 150% of that is actually 12,000. So we believe this will actually be raised above the 10,000 you see here. They are subject to Roth treatments if you are over 100, if you earn over 145,000. This is one of the areas you'll see at the bottom. We need a technical correction in this section. They actually, when they were drafting it, they missed a piece that needed to be in there. So right now it technically says you can't have a catch-up contribution if you're over the 145,000 indexed, but it's something we need to watch, and it will be corrected. We're just not sure when that we're going to get the correction or clarification there. And it is, the IRAs now have been increased for a catch-up limit and is now indexed as well. Next slide. In the past, if you had a simple 401k plan and you wanted mid-year, you decided you wanted to do a simple IRA, and you wanted to do a 401k, you could not switch in the middle of the year. You had to terminate your simple IRA on 1 year. You had to wait to day one for the next year and start the 401k. They have allowed you to make this change mid-year if you go to a simple 401k or a 401k with a safe harbor provision. So this is a great feature or addition, we feel, for those companies that now are ready to, they've outgrown the other smaller plans, they're ready to make some other changes inside their plans, and they want to move ahead. So we really like this one. This is optional. You would only do this if you were going to make that change mid-year. Next slide. The matching contributions for student loan payments is another area. We have had a lot of people asking about this in the past. This is a great tool for if you're trying to attract or retain, especially the younger people that you're trying to hire. Keep in mind that if you have a student loan, it doesn't just mean the student. If you are a parent and you also have taken out student loans for your child, this does apply in that situation as well. And what it allows is for the employer to use what the student is paying on their student loan as if it is an actual deferral into the plan. When that happens, then they can actually make a match into the plan on behalf of them. This is totally optional. This is one of the areas where we're still trying to figure out how this is all going to work. But the other thing that was added here, which is really good, is it is tested separately. So in the past, when they were trying to figure out how this was going to work, it could dramatically affect the testing on, because that money is not coming in, and how all those numbers worked. But now you can carve that out even though they get that match. Again, optional, something you're going to want to talk to your plan administrator, your advisor, or your record keeper. And this one probably, and Karen can elaborate more as we go through, but this one's going to probably take a little more time for how we are going to be able to get this done, or when this can really happen. Next poll question, I'll turn it over to Jim.
Good, thank you, Marie. Very helpful with that. Very insightful. Okay, next polling question here. Does your organization sponsor any programs to assist employees with managing their student loan obligations? the selection, the choices are yes, we provide financial planning assistance to employees. No, but we plan to use the 401k matching contribution provisions that are part of the bill here. Or no, we do not provide any financial planning assistance. So again, this is, so please indicate your response to this polling question. Again, this is an area of concern that a number of employers obviously are looking at is student loan obligations, with retirement plans, or there are even some provisions, from the CARES Act a couple years ago that passed to provide some assistance for some of their employees. Again, in today's workforce, it's important to address that to the extent that they can try to assist some of their employees that have student loans. Okay, let's see that some of the responses to this to the question. First, yes, we provide financial planning assistance, 18%, 7% no, but they plan to use one of these contribution provisions here. And the last, no, we don't provide anything. So, okay, well, it's helpful to to gauge that the response here with it. Good, thank you very much for that. Moving on now. With the poll question, our next area that we're going to cover here. Next slide, please. Karen there. Okay.
Karen may have had an internet issue. Megan, can you pull up the slides?
Thank you.
Good morning, everybody. I just had some internet issues, of course, happens as it's time. Are you able to hear me now?
Yes.
We can.
Okay, perfect. I apologize. It's perfect timing that I get the message that says you have a bad internet connection. So apologies. I'm going to leave my camera off. Hopefully that's going to help with the bandwidth issues here as well this morning. So apologies. At least it feels like technology is in my favor again. So great. So I'm going to kick off and cover some of the plan provisions that will be effective with Secure 2.0. The first one is going to be the long-term part-time eligibility. These provisions were enacted with Secure 1.0, and now Secure 2.0 changes those provisions. So it's created some complexity for plan administrators for operating the old provisions, which are going to become effective before the new ones come effective. So the reason that this was implemented was to allow for expanded retirement savings for this part-time employee population. Congress believes that this is sort of an underserved population in terms of having the opportunity to save for retirement. So Secure 1.0 rather included that if you have part-time employees that are considered long-term, meaning they worked for you for 3 years of consecutive service and they worked 500 hours in each of those years, that they should be offered the ability to participate in the plan. So the timing of when this kicked in with Secure 1.0 is actually January 1st of 2024 is the first time that provision was going to be effective. But it looks then at the hours that your employees worked in 2021, 2022, and 2023. So the requirement in place right now is to look at your employees who worked in each of those years, and if they worked those 500 hours in each of those 3 consecutive years, you need to offer them the opportunity to participate in the plan January 1st of 2024. Secure 2.0 came in and changed that 3-year rule to a 2-year rule and gave us a new effective date. So the Secure 2.0 rule becomes effective essentially for calendar year plans in 2025. So that means on January 1st, 2025, if you had employees working more than those 500 hours in 2023 and 2024, those employees would need to be offered participation January 1st of 2025. So we have 2 sets of rules that are sort of overlapping here to be tracking. For employees that have this type of a population where your part-time employees stay with you year after year, it's important to really make sure you've got good tracking mechanism in place for ensuring that you've got the proper employees offered participation in the plan at the proper time. Some plan sponsors may want to look and see, do you want to track all these hours requirements, or consider offering, eligibility to participate to all your employees in the plan. And then just if you're working for the employer, you're eligible to participate. You of course could still have a different rule for your company contributions or employer contributions. This rule only requires you to offer employee deferrals. It does not require them to participate in employer contributions. So, take a look at how this might impact your workforce. Talk to your consultant advisor and see, is it something that you want to make some plan changes in order to eliminate some of the tracking requirements that are coming along with this. They did simplify some of the testing and allow these to be carved out. So this portion of the workforce then, should not negatively impact your ADP ACP testing if you're subject to that, for example. So some good changes to try to simplify it, but there's a lot involved here for those workforces who have part-time employees that stay year after year within your organization. See if my computer's going to work. Yes, so technology is improving for me. We all know that with the complexity of the rules that we have, a lot of errors happen. Things go wrong in retirement plans, and in the audits that our firm does, we find a lot of them. We don't find all of them, but it's regularly, no matter how diligent plan sponsors are, there's opportunities for things to go wrong. One of the areas that things often go wrong in is offering plan participation to your participants when they become eligible. The complexity of your plan's eligibility rules, people change status, all sorts of things can go wrong with that process. I was just talking to a client yesterday, and they noted, they had really good processes, but inevitably this, strange set of facts happens, and it's got to be a manual change to find this one person out of 1,000 employees who had this unique circumstance, and they missed offering the opportunity to participate. And of course, if you have auto enrollment, that also, has that administrative burden to ensure that once those participants do become eligible, you're affirmatively enrolling them in the plan at the appropriate rate. And you also have provisions to auto increase or auto escalate participants in enacting that. So those rules, provide for lots of opportunities for things to go wrong. The good news is that the IRS has for a number of years had a set of rules out there for how you fix problems, and it's under this EPCRS program. That program has a set of rules of how plan sponsors can self-correct things. There's a set of suggested or acceptable methods of how you correct a variety of errors. There's a set of rules that say, well, you can fix them, but you can't self-correct them. You have to get IRS approval in order to correct them. And then there's a set of rules that say when the IRS finds those errors, what the implications of those things are going to be. So it's a fairly lengthy set of regulations out there. So what the Congress is saying is, let's continue to improve on that program. Let's expand it. They're directing the IRS to add additional self-correction options of errors related to participant loans. A lot of things go wrong in there in terms of issuing them under incorrect circumstances, not defaulting them, the administrations related to participant loans and 401k and 403b plans, IRA, more self-correction in that area, as well as RMDs. You've seen a lot of discussion on the RMD and penalties and things, but some more procedures surrounding that as well. And Congress is directing the IRS to provide guidance on these areas not later than 2 years after enactment. We don't have any idea what is going to be in there and when it's going to come out. It's interesting that the Congress is stepping in and kind of telling the IRS what they need to do in this area. Oftentimes the IRS initiates and comes out with those rules themselves. The next one is that it also expands and allows any eligible inadvertent failure as defined under this regulations to be self-corrected under here. There's a series of sort of complicated rules that indicate whether or not the error is significant or insignificant, and it's sort of facts and circumstance, but there's a number of factors you look at under each of those categories. Certain factors could always be self-corrected. Others could only be corrected within, a 3-year window, for example. So what the rule now is saying is that the 3-year rule is gone. You can correct at any time whether or not they fall under these other categories of significant or insignificant. So this is a really nice feature to expand the ability for plan sponsors to make corrections that, if they missed that 3-year window, they would have previously not been able to do. You still have to find it before the IRS finds it. And when you do find the error, you have to still correct it within a reasonable period of time after that failure is identified. So this is a welcome change to really expand the ability for plan sponsors to correct these errors without needing to pay the IRS user fees and the time and cost to go under the programs. There's also, I mentioned some of the errors happen specifically in the auto enrollment or the auto escalation environment. If you fail to properly auto enroll or enroll a participant when they make a deferral election or just don't offer the opportunity to that participant, the way that it gets corrected, the IRS self-correction program is to put the employee in a position had the error not occurred. And so the IRS believes in this instance, it would be appropriate for the employer to make a contribution called a QNEC on the employee's behalf equal to 50% of the amount that the employee would have contributed. So if your plan has an auto enrollment provision at 3% and you failed to auto enroll that participant, the company would put a 1.5% contribution that the company pays into the plan to make that participant whole for the missed deferral opportunity for them to put their 3% in. The company or the organization would also put in the matching contribution that they would have been entitled to. So the company would have already made that matching contribution, so there's really no incremental cost there. So it's that employee deferral component and that, in my example, that 1.5% that the company would put in that the employee would have paid in, had they had that opportunity. So the IRS recognizes that in auto enrollment plans that there's more opportunity for those things to go wrong, and in auto enrollment plans, if the error is corrected within 9.5 months after the end of the plan year that the error occurred in, helping the participant get enrolled, follows all the proper rules, then that actually there's no corrective contribution required. So in my example, that 1.5% component is not required to be made. You would still make the company matching contributions and applicable earnings, but you don't have that extra cost to the company. The IRS has been put this provision in. It was scheduled to sunset. It's been expanded. Prior to Secure 2.0, it was scheduled to expire after this calendar year. This act actually makes that permanent. So that's a great feature for plan sponsors to be able to continue to not have that cost component when they find an error and don't fix it immediately in the plan. Another error that often occurs is overpayments in retirement plans. The IRS rules indicate that if you overpay a participant, back to my comment about participants should be put in the position had the error not occurred, if they receive an overpayment, then the plan is supposed to, try to recoup those payments from the participant. In situations when you have a terminated participant, I've yet to see one of those terminated participants willingly send the money back to the plan. You have instances where the retirees are getting a pension and their pension payments have been too high for a number of years. And you look at the cumulative amount of those overpayments and you're going to, a retiree asking for all these monies to be sent back. So what this does is it provides fiduciaries with relief from inadvertent benefit plan overpayments. They put certain rules into place that the fiduciaries of the plan are not failing to meet plan and operational requirements because they're not recouping those money from the participants if they follow certain rules. So it's a welcome change, particularly for some of these, small overpayments that happen in 401k plans where they overmatch or they, send too many deferrals and things like that, and the participants are terminated and it's difficult to make those corrections in the plan. So these instances will not affect the qualified status of the plan. So another good change. I know we've talked about all these just additional administrative challenges, but there are some good rules in here that are going to be helpful to plan sponsors in administering the plan. Another helpful provision that was enacted into the law is the elimination of some notices and disclosures. If you've been in the plan sponsor world or retirement plan world for a while, you've seen increased notice disclosures, just more and more and more paperwork, fee disclosures, you name it, there's a disclosure for everything, and they're all at different times. And so just cost of administering the plans just becomes more challenging as you have to put notices out that I would argue most people don't read. But those disclosures are out there, and they're required to be provided to all plan participants. And a participant is defined as someone who's eligible to participate in the plan. So that means in a 401k or 403b, if they're eligible, even if they have no money in the plan because they chose not to participate, you still have to provide them with disclosures of things like the fees, the performance, summary annual reports, things like that, that just are not really relevant to those participants. So now you still have to provide the summary plan description to ensure that they are aware of the plan's features, but you don't have to give all the notices that are not relevant to those that don't have any money in the plan. So a nice change there where we aren't inundating people with paperwork they don't need. MEPs and PEPs are kind of the emerging types of vehicles that plan sponsors can be using, primarily small plans where they really don't want to participate in all the rules of administering a plan. They don't want to change the fund lineup. They have a small plan. They want some benefits of some better investment choices, things like that. So we see more small plans entering either the multiple employer plan world or the pooled employer plan. Previously, that was only available for 401k plans, but that's been expanded to the 403b plan market now as well. So we are seeing, these types of plans grow, and as rules are more clear on those areas, I think we're going to continue to see an increase in participation in the small plan market. Withdrawals and distributions, in order to encourage participants to save, the Congress wants participants to have access to money in certain instances. In general, in a retirement plan, you can only receive money on a distributable event. So that's typically termination of employment, retirement, death, disability, or certain in-service rules. Hardship withdrawals have always been an optional provision to include in plans. However, there's been some, just administrative challenges with administering some of those provisions. And hardship withdrawal previously, employees had to provide support for the reason for their hardship. So if you're saying that you needed it for medical expenses, copies of invoices, things like that needed to be provided. And then you start to run into some PHI concerns about providing that information to employers. So there's been some complexities and challenges in that area. So the IRS is now simplifying it and saying that administrators may rely on employee certifications of the hardship requirements. We don't have to submit the support anymore for, you're buying a house, tuition, whatever the reason are that the participant is claiming. So you can rely on those unless you know something to the contrary. This is one that, record keepers will need time to update their systems to eliminate those rules. So you'll be hearing information from your record keeper in terms of how this is administered for your organization. Domestic abuse distributions, there's some penalty-free opportunities there, and they can repay distributions into the plan. Terminal illness distributions, same thing. They have penalty-free distributions there as well. Qualified birth and adoption distributions, they have the opportunity to repay them. Early distributions, there's always been a penalty-free distribution option for public safety officers who are age 50. Now, in addition, if they have 25 years of service, they can also have a penalty-free distribution. And this was expanded to be correction officers of state and local governments as well. Withdrawals for emergency expenses, you can have an exception from the 10% excise penalty here. Only one distribution a year up to $1,000, and they can repay that in a certain, within the 3-year period of time. That should be effective next year. Federally declared disaster areas. This essentially just makes permanent certain rules that have been in place and just allows for, in general, not specific amendments to be made for every single, declared disaster area. So this is really just making some provisions permanent that have been around for a while. The cash out limit, this is for simplifying plan administrations. Many plans have a provision that if participants terminate from the plan, they previously, if they have a provision that was optional in the plan that says they're less than $5,000, they can take that money out. That's going to be increased to $7,000. It just has never been changed since that provision was in. So that'll be a welcome change as well, to be able to get more money out of the plan and not have to have notices and things going out to participants for a period of time. The next one relates to treatment of matching or profit sharing contributions as Roth IRA. This becomes effective immediately, which is interesting because we really don't know how to administer this provision. It is optional that the plan sponsor can choose whether or not to offer this provision. Of course, once the record keepers figure out how to do it, once regulations are provided, but essentially it provides participants with the option of matching contributions on deferrals or the student loan payments, and they've got to be taxed on it. So we really just essentially don't know how to handle the taxability component of this, because once the plan sponsor would choose to offer the provision, and then the plan participant would choose if they want the Roth treatment in the plan. So a lot of administrative complexity there, and we don't have any guidance yet as to how we would actually administer that provision in plans. I think we're at the next poll question, Jim.
Okay, thank you very much, Karen. I appreciate your help with that. We've had a number of questions come in here too. We'll try to address those here, but let's do our next polling question here. What is your opinion of the Secure 2.0 provisions? First, they benefit plan participants and sponsors. Secondly, they're complex and challenge sponsors to add requirements. Or third, I'm too lost to have a current opinion. So again, we've got the three selections here. So take a moment there and give your response. As you're doing that, just one item that we note here, again, it came through in the question feature we'll get to, and again, we'll address some of the other items at the end when we have time, is with all these dates we've talked about, if we're going to put some white paper or some, report together with all these different effective dates, you keep track of them. We do have a Sikich article that we will be sending out a tax alert on Secure 2.0, and we will include the schedule with some of the different effective dates on there to help you keep track of some of the effective dates with it there. So one item to note on the effective date that Karen covered on the slide with those distributions, during disasters, from storms and whatnot, that was actually back to 2021 on there. So again, these dates are very important to make sure that you're aware of. Okay, let's look at the responses here. First one, the Secure 2.0 benefits plan participants and sponsors, 48%. Almost the same here. They're complex and challenge sponsors to add requirements, 45%. Again, then I'm too lost to have a current opinion. We've got 7% there. So again, we appreciate your responses with our polling question here. Okay. Next, we're going to move on to a next area, just some other provisions here that we're going to cover here. We've got the next slide here.
Yep. Thanks, Jim. And I'm glad to see we only had a small percentage that we've completely lost you. So 7%, I guess we'll take that as a win. Hopefully we haven't
That's right.
people on today's webinar. So we'll go through some of these. We kind of call them miscellaneous provisions. We didn't think they had as big of an impact. Doesn't mean that they might not be relevant to your organization, but some of them are just further out and probably just not, as highlights of the presentation earlier. On benefit statements, this one we have two schools of thoughts on if it's good or not. And we know that in defined contribution plans, participants typically are getting quarterly participant statements on your 401k plan. Most of us have elected to get those electronically anymore. I'm sure there's a number of people that still receive those in paper, but I think the majority of people are doing it electronic. There's a series of rules out there for when they can be provided electronically, if unless the participant opted out, for example. What this one does is it's kind of going back in time and saying, it's great to send 3 quarterly statements out electronically, but you must send one out in paper every year. So some people believe, well, that's great because participants don't log into their websites. They don't pay attention to the 401k plan. So at least once a year, they'll have a statement come in the mail to remind them, that the account balance is out there, or if you've left an employer as a reminder. And the other school of thought is the costs to mail things in today's world and the opportunity for, those statements to get in the wrong hands and have access to, sensitive information that could lead to theft or risk of issues happening with the retirement plan. So that's not in effect until 2026. So we'll see how, if anything changes there, and how record keepers are going to reprogram systems to handle that feature. Defined benefit plans, would need to get a statement every 3 years in paper as well. Long-term care bought with retirement dollars, another opportunity for distributions from plans, penalty-free up to $2,500 a year if you're using those for eligible long-term care premiums. That's effective 3 years from now, or from last December. Provisions related to firefighter and first responders. That age 50 rule I talked about earlier that's out there for public safety officers now been extended to private firefighter, effective immediately, and excludes some service-connected disability retirement payments as well from retirement age. So things we saw in the public sector are now being expanded to the private sector as well. It would be a welcome change. For our governmental 457 clients out there today, they've eliminated the first day of the month requirement in those plans. So really operating more similarly to the 401k, 403b environment, where those plans can choose to allow participants to enroll in the plan immediately and not have to wait, a month out to start participating in the plan. We have, some more guidance on this performance benchmark for asset allocation funds. These designated investment alternatives held by the plan, fiduciaries can use different benchmarks now in order to appropriately measure their own asset allocation funds. So they're changing up some of the rules there. We'll be waiting for Department of Labor guidance on what exactly that means, but they're looking at that area as well to provide some better fiduciary relief of what is appropriate to use in those instances. Similar in retirement, in defined contribution retirement plans, there's been a goal to figure out how to sort of annuitize the plan so that it can operate as a defined benefit plan, or really a true retirement plan pension, and help participants learn how to create a stream of payments to ensure that they have money until they retire. So there's been a movement to adding different types of products into plans that would allow participants to create those sort of annuity streams. And so this is really to simplify some of these limits and make these products more attractive for participants to use. So there's some simplification coming into the new contracts there. Then this is an interesting one. They're supposed to create a lost and found for retirement money. So right now, participants leave the plan, they forget it's there. We talked about that small amount cash out. So if you had a participant and they had $2,000 in your plan, you might have set up an IRA for them at some trust company. The participants completely lost track of where that is because they moved, they don't have the right address or contact information, or some get referred to state lost and found or abandoned property, unclaimed property situations. So the Department of Labor is supposed to figure out how to create this database within the next 2 years of how participants can go out and find their lost and found. So that'll be interesting. There's some concerns with privacy surrounding that area, things like that on that. So that'll be interesting to see how that shakes out. Emergency savings accounts, again, access to money for participants that they can create this within their plan. And have access to up to $2,500, be able to come out of the plan and just have access to that money without having distribution costs. So it's kind of creating a savings account within the retirement account to offer participants access to monies that they might need for certain emergencies. So similar to the hardship, but sometimes things happen that don't meet the hardship requirement. So this would be a vehicle to whatever the participant defines as an emergency to have access to that. Automatic portability, on that same vein of trying to let participants keep their money and not lose it out there. This would allow service providers like your Fidelity, Vanguard, Principals of the world to provide plans with this automatic portability, and they'd automatically transfer the money into a default IRA into the new employer's plan. So I'm not sure how they're going to know where the new employer's plan is, but it allows them to move this from one plan to another. So interesting way to streamline it. We'll see how that actually operates. There's a savers credit enhancement. So for certain participants that are under a certain income level, they've always been able to receive a tax credit on their 1040 when they file. That tax credit is going to change from that tax refund on the 1040 to a federal matching contribution that gets deposited into their IRA or the retirement plan if the plan allows. It's, that will be calculated under different rules. So I'm not sure how many retirement plans are going to allow for federal contributions to come into their retirement plan. It sort of sounds like an administrative challenge. And I'm not sure how many participants are going to set up their own IRA account. But the concept is that instead of the participants taking the money, spending it immediately on whatever they deem necessary, that it's going to be forced kind of to go into a retirement plan. So it's got a good theory and goal. Operationally, we'll see how that works in 2027. So that was where we summarized the highlights, if you will, of the 90-some provisions. I don't know if we've got any. Looks like we've got about 5 minutes left. If Marie or Jim, there's any questions that you think we can cover within that period.
Yeah. I'll go through some of the questions here, and either you could address it again with some of these ones we may not know the guidance with it, but let's address some of the first ones. Marie, you talked about the startup credit for it. For the 50 employees with it, is it 50 full-time employees or full-time equivalents for that determination to get the full credit?
I will defer that to Karen to see if she knows exactly that definition.
I would have to look that one up as well. I want to say it's employees. Now, the full-time equivalent is a term used a lot in the Affordable Care Act area. I think in the retirement plan space, a lot of it stays with the employee headcount per se, but we can get back with more of the clarity on that specific rule.
Okay, yeah, I would think it'd probably be the number of the participants in the plan, but we can check on that.
Right.
Next one, for purposes of the employee counts for the credits for the startup plans, does this count only eligible employees, or is there a different definition, kind of the same theme with that? I guess we can check on that further.
Yeah, historically, those are based on eligible participants, total participants, which would mean eligible, not just those electing to participate in the plan. I would think that would be true. Otherwise, you could have 100. We've got some plans that have 100 employees in them that are eligible, and I have 10 people in the plan. I don't define that as a small plan from that perspective. So.
Okay. For the catch-up provisions that we talked about earlier, are the catch-up provisions affected by the HCE, highly compensated employee limitations?
Yeah, so the definition of a catch-up contribution, that's a great point. We often think of it as going over our 402G limit. So that annual contribution number, it just lets us put that extra, $7,500 into the plan. So that's what most of us think of as a catch-up contribution. Those regulations actually also put a catch-up contribution in if you want to recharacterize money to pass your ADP testing, things like that in the highly compensated world. So those are some of the administrative complexities that come in when you're going to have to call catch-up contributions Roth when you want to use some of those features to pass corrections. The Roth rule for the catch-ups comes into effect for those earning more than $145,000, which is a different definition. Right. The highly compensated individual, under that statute. But for those individuals, those are the ones that will be forced to do the catch-up contributions as Roth if the Congress changes the law, which allows for it. Right now, unfortunately, no one over 145,000 can make a catch-up contribution as it's currently drafted, hoping that that gets rectified. So if we didn't answer that question, feel free to send in an additional one to make sure we're.
I think you're right, Karen. I think that's the one with the catch-up with it that again needs that technical correction by Congress with it.
Right.
The last one here that we'll get to, and then again the other ones that we've had, again we will respond to those. This is a small business credit for adopting a 403B plan. Was that be refundable if it was for a small not-for-profit company as opposed to a regular, taxable business? Are they able to get this small business credit if they're not, tax-paying entity? I'm not aware.
No, unfortunately not. Because you're not a tax-paying entity, they're not eligible for 403B institutions. It would only be for those tax-paying entities that would have an opportunity to have the reduction in their taxes for that.
Right, good. Okay. Like I said, we've got a number of other questions here that we will respond back to you on. We thank you so much for that. Again, as a reminder now, please complete the survey that pops up at the end of the webinar. There's actually some questions in there. Well, there's even one, a fun one on the Super Bowl in there for you. So take a look at that. We'll follow up with answers to any of the questions, again, that you have today, and more on the Secure 2.0. Please, again, as we mentioned, that some of these items we're going to wait for further guidance from the IRS, so keep an eye for that. And again, we appreciate you attending our session today. Again, I want to thank our host here and presenters, Karen and Marie, for their help, and also want to thank Megan, Maris, and Stephanie for their assistance with it. So thank you again for joining us with Sikich here, and have a wonderful day. Thank you.
Thank you.
Thanks, everybody.